Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table.
All right, welcome back everybody to another episode of Integrated Insights with ICCG. My name is Michael, I'm your host today, here with Grant. Today we're going to be talking about the value or what companies are worth. So we have a lot of business owners come to us. Probably one of our most frequently asked questions, right? We've done a couple of those episodes, but probably our most frequently asked question is, Grant, what is my company worth? How do we start answering that question?
Yeah, there's some industries that, are valued typically differently than others. Your service industries sometimes are a function of gross revenue. Some distribution businesses are a function of gross profit, depending on what type of distribution it is. But for the vast majority of other companies, it is going to be the higher of a multiple of EBITDA, of cash flow that you're going to get on an annual basis, or the value of the equipment or the fixed assets. And so, the best example of the fixed asset one is a car dealership. The car dealership may be worth, several $1 million for the cash flow, but the real estate that it sits on might be worth a ton of money. We talked to an indoor soccer stadium not too long ago, and the real estate that they're on is just very, very expensive. And so for somebody to come in and buy their business, they'd have to buy that property, and there's just no way that the business is worth even close to the value of the real estate. That happens a lot with like these Montessori schools or daycare centers. They build them, and then the value of the business, the cash flow of the business is not tremendous. It's good, but it's not as much as the value of the real estate. And so, but most of the time we're getting to a multiple of cash flow. And the way that the industry calculates cash flow is generally something called earnings before interest, taxes, depreciation, and amortization, which is EBITDA. It's not. Look, people are wising up, and I think Warren Buffett actually threw EBITDA under the bus the most. But I think most people understand that the assets are generating some sort of cash flow, and then they need to pay a multiple of that cash flow. And the way that's generally calculated, and I'm going to use some simple sort of math here, but if your company is let's just say somebody comes in and they say, we're going to pay 5 times EBITDA. And let's just say your EBITDA is $20. Then 5 times would be $100. What they want is they want a 20% return on the investment, because I'm buying the company for $100. Every year I'm going to get $20 in return. So a 5 times EBITDA is really anticipating a 20% return. That's just how it works. And so how predictable is that 20% return? I might be in a bid war, and I might think, man, it's very predictable. And so I might be, okay with a 15% return. Well, now my multiple will go up. But if it's unpredictable, see also like a construction company, then, and I've got new customers, every single customer is a new customer in a construction firm, mostly, then it's not predictable. And so I'm not going to pay 5 times, because for me to get that 20% return, I need a little bit more predictability. And so I might pay 3.5 times EBITDA. And so that's kind of the basis. And I know that's really, really a lot of technical speak, but I think most people deal with the valuation as a function of cash flow.
That's great. That's great. So you dug into EBITDA a little bit as the term, what it stands for, some of the history there. Talk about what else is done to that EBITDA number. Talk about the recast process, what kind of items are recast out, and how that plays into the pre-multiple number that we come to.
Yeah, and just, it's a great reminder. We have developed just a real simple tool that we give to people who are trying to figure out what is my recast EBITDA, right? What is my normalized EBITDA, or what is the EBITDA that a buyer might be looking at? And so if you're listening to this podcast and you want a copy of that, then, get in touch with us and we'll send you it. It's not rocket science. It just basically, you get your P&L and then you add some things back that are the definition of EBITDA, interest, taxes, depreciation, and amortization. And then you have to recast or normalize that EBITDA or that cash flow for items that the buyer is not going to need to pay. In other words, if there's a one-time cost that you threw in repairs or maintenance, then you probably could add that back.
Yeah, like what we saw recently was an installation of a security system. Right?
Yeah, exactly. There you go.
That every year, right?
That's right. Yeah, that's $72,000 installation, right? And now it's a few $100s a year, just as a monitoring cost. I think the most common one is related party transactions. So things that are your owner's wages, maybe overstated from what the normal price of that kind of skill level is. It could be that you're paying family out of there. You could be paying your alumni association dues. You could be traveling Europe and probably trying to run through some personal expenses through your P&L to lower your tax bill, basically. And I know that's not what you're supposed to say, but I think the way that we justify it is not really by saying they're personal expenses. We say those are owner-elected items that will probably not be elected by the buyer.
Yeah, not a whole lot of argument there in those cases, right? People see those add back items and they're like, oh yeah, that makes sense.
Right. And so we just looked at a financial statement of a company just the other day, Michael, remember, where they actually put out a report that talked about recast items that would get the owner an orange suit. Right? I mean, he would be going to jail, and the broker that was hired was basically giving that report out, right? And that's just stupid, right? And so that's why we don't say, these are personal expenses. We don't say, we have, $250,000 of receipts that we don't deposit in the bank account, so we don't have to pay taxes on. You never say those kinds of things to anybody. You don't even infer it. And so you have to be careful what you include in that recast, piece there, because it is discoverable, and you don't want that information to get in the wrong hands. They own you at that point.
To be clear, when we're advising clients, we're making sure those items are booked, right? And then we're also not trying to recast them out because they shouldn't be recast out.
Well, we don't tell our clients what to do with regards to that. We let their CPAs and tax advisors and lawyers, make those final calls. But we're realistic in making sure that the information that's communicated to buyers or potential buyers is not going to get them into trouble.
Mm-hmm. Yeah, that's great. That's awesome. So that's a little bit of a deep dive into the EBITDA piece. So let's talk more about the multiple side of it. So multiple ranges are different by industry. Obviously, a company is going to be up and down on that range, depending on the performance of their company. Talk about those factors a little bit. Give some examples, maybe of a couple industry differences on range, as well as what's going to make somebody fall higher versus lower on that sliding scale.
Yeah, I was joking with somebody just yesterday about multiples, and you never want to believe your golf buddy on the multiple that he received, right? If it wasn't for country clubs and golf courses, our job would be so easy, because the stuff that's talked about is just crazy. We hear, 18 times multiples and all kinds of nonsense out of people. And, you have to deal with a very unique situation before you start dealing with anything in excess of 10 multiple. And I would say it happens. We've certainly seen it. We sold one of our companies for a greater than a 10 multiple, but there were some unique circumstances, and so they were revenue models that were different. There are, there's a romance to some revenue models that just get larger returns. And so if you've got a higher net income than $10 million a year, then you can achieve a higher multiple than if you have a $2.5 million EBITDA. Certainly if you have a $250,000 net income, you're going to be on the lower end of that industry scale for sure.
Yeah, and that's why PE groups are around, right? That's why they do what they do a little bit to get to those tiered multiple levels. Talk a little bit more about that, about tiers and how the different levels they can get higher multiples.
Yeah, people badmouth PE groups all the time. And really some of it's deserved, to be honest. But one of the most fun guys that we've gotten to meet, super wealthy, very successful PE guy out of Boston. He said, you always can trust the motives of a PE group. They're pure motives. And that is they are doing what they're doing to make money. And the way they make money is they will buy a company, they'll buy 10 companies that have $1 million EBITDAs. And then they will sell it as one $10 million company and get higher multiples because of the scale that I just told you, right? So they may pay 3.5 times and then sell it for 5 or 6 or 7 times because it's a $10 million EBITDA. If you got over $100 million of EBITDA, you're getting way up the food chain, and people are then have their eyes on accumulating a few of those and going public, and the public market has crazy multiples of EBITDA.
So just to put you on the spot a little bit on that range question, talk about the multiple range for, say, oil and gas industry versus landscaping. How do those ranges differ, and what's kind of the why behind that differentiation?
Yes, that's such a great question, because people always want to know that. And the reality of it is you have to go deeper, because if you are dealing with consistent customer base in landscaping that's maintenance, that is, that is predictable, that the logos don't change. In other words, customer base is consistent, and it's repeat revenue and all. You're going to get a higher multiple than if you're doing lawn and landscape, where 70% of your revenue or your net income comes from custom, design and installation, because you don't do that twice for the same customer generally. And the oil and gas industry is exactly the same. You have all kinds of pieces and parts to that industry. There's well servicing, there's testing, there's all kinds of repeat business as well. And so, and then there's, the whole exploration piece of that, which is up and down like crazy. And then you got the most boring part of that industry is just the accumulation of royalty interests. And so which a lot of times is the pricing is not even on EBITDA, because it's just royalties. And so it's a multiple of gross income. So, it's hard to be nailed down to any particular multiple. But again, I'm going to go back to the very first few minutes of the podcast, and I will say the most predictable you can make it, the higher the multiple can be. And, I will tell you, probably 15 to 20 years ago, we saw consolidation in the lawn and landscape business that were giving out 14 and 15 times multiples. And the whole reason we saw that in the pool building industry as well, which was crazy. And of course, most of those roll-ups failed eventually, but the people that actually put those deals together and took them to the public market, they made bank and then left these companies holding the bag, and the share prices just tanked. And so I would tell you that you just have to be, every situation is unique, every company is unique, and it depends on the revenue model.
Yeah. So if a business owner is primarily servicing an oil and gas industry, something like that, something that just the consistency isn't there to support a higher multiple necessarily, say manufacturing supporting the oil and gas industry. What if a business owner has a goal to get to a certain EBITDA, certain multiple, certain total valuation, how would you advise them? How would you advise them to move toward that and to maybe increase the multiple to do so?
Yeah, we're in Texas, right? And so, for the most part, and so we deal a lot with people that serve the oil and gas industry. We generally, like in the manufacturing companies that we've sold, and we've done quite a few of those. It is always, I would say 90% of the buyers out there want more diversification outside of the oil and gas industry. They love the gravy, but they don't want to rely on it. And so they want production work for example, the aerospace industry, or the other types of manufacturing, that's needed in this area. And again, if you're a manufacturing guy and you're serving the oil and gas industry and you're doing something that is needed on an ongoing basis all the time, you're manufacturing valves, or you're dealing with pumps that are being replaced every year. That's different than, machining equipment for the drilling rigs, because that dries up in a big way.
So this is something we haven't really talked about yet on this episode, but what about succession planning? How does that factor into this conversation? How does that affect the value of a business?
Yeah, that's really, really difficult. And so let's just say dad is wanting to sell his business to let's say has two, like a son and a daughter in the business, and he wants to sell the business because he doesn't have as much retirement assets as he wants to retire, right? A common situation is most valuable asset is his business. And so he needs some money off the table for him to walk out the door. And so, what's the company worth? We have lots of complex discussions because ultimately it's a closed transaction. He's not taking it to market. And so he's really not going to figure out exactly what that company's worth. You don't want to overprice it and burden your kids with a bunch of debt. At the same time, you want to be fair and maybe you have other kids. And so you want to be fair to those other kids and not give it to those two kids, right? And so, those are hard conversations. And I would say there's an emotional side of determining what that value is. It's kind of like asking somebody what's enough, but that comes into it for sure. And there's ways that we help in that scenario where you got the son and daughter, let's say, that are in the business, but then you've got, another kid that's not, then maybe there's a way that you can set up the transaction to where that other kid that's not involved in the business is taken care of, not by ownership interest, but by some sort of an amount that's set aside for that particular beneficiary. And so, those are squishy. Takes a lot of conversation. Make sure that you're not dealing with your financial goals only. You're dealing with your heritage goals, right? Your legacy goals.
So what about a different version of a similar conversation there? So say a business owner comes to you running a great company. Say last year they hit $5 million EBITDA, and the previous 2 years they've just been improving and increasing that EBITDA consistently over the year. But that business owner has his hands in every piece of the business, and he's the person pushing down the pedal. He doesn't have that manager ready to kind of take the reins and do that for him. How does that play into the value conversation? Is that impacted? Do they slide up and down that scale? What does that look like?
I think you have to sit down and, I remember sitting down with this one guy, and his impression is that, he does everything. But if you ask everybody else in the company, what he does is he comes in, creates a problem, solves a problem, and then goes home and thinks he's done everything the whole day, right?
Sounds like my boss.
That is, exactly. That's exactly what his senior management told us. And this was a pretty good sized company, and they, look, nobody appreciates what entrepreneurs do to create a business. They just don't. It's hard to appreciate it unless you've been in those shoes. At the same time, you have to be realistic and understand that a buyer is going to have to pay for labor, bad word maybe, pay for expertise that is going to accomplish what you do on a daily basis. And so it's not going to be exactly the way that you do it. But, if you're doing, I'm going to pick just a nominal thing, like, if you're the only guy that can repair the machinery because it's as old as you are, and all the young guys have no clue, then your business is dependent on you. And, either they're going to have to replace the machinery or they're going to have to find another you. And that's expensive. And they're going to factor that into the price for sure.
That's great. So we've talked a lot about kind of the financial the financial pieces that play into the conversation, but obviously there's that sliding multiple. So what are some of the other non-financial factors that we haven't talked about already that play into where you land on that scale?
Yeah, we actually have a slide that we use in our initial pitches that we give people that have different factors that produce a premium and different factors that produce a discount. It's not comprehensive at all, but it includes things like, concentration of sales. I mean, if you have one customer, then, you lose the one customer and the buyer is SOL, right? And so it's just, there are other factors. Some of it is geography. If you're in, Podunk and you just can't get there, and there's no skilled labor around there, there's no way that you can hire sophisticated people because they don't want to live in the middle of the desert, then, it's difficult to sell that business.
Well, we've talked on previous episodes about the due diligence process and what that looks like during that business transaction process. But how can a business best prepare for that so that they're ready when it's time to do a transaction?
Yeah, and I'll tell you, this goes back to what you just asked me just a minute ago, because it is time and time again, we give the buyer enough information to make an offer, and let's just say they offer $10 million for the company. Well, then we give them their answers to the due diligence questions, and it is different, or it makes the initial information almost misleading enough to where they come back and they go, look, if we had known this, then we would never have offered as much as what we did. And so we can only pay $7 million for the company now. And that's not going to meet the client's goals. And so we've just wasted several months. I would say the best thing you can do is have advisors around that are actually preparing the initial information that you give them consistent with the way that the due diligence information is going to be revealed. In other words, when we put together that, everybody calls a package or SIM or whatever you want to call it, a deck, when we put that together, we're basing it on the information that ultimately is going to be given to the potential buyer in the middle of due diligence, and we're confident that whatever is going to come up is not going to contradict that information at the very least. And honestly, Dave, who's been on this podcast, last week and will be on there next week, I'm sure, he's famous. I mean, I cannot stand this saying that he says, but it's brilliant. He says, bad news doesn't get any better with age. And I always used to, think that being cagey was going to kind of win, like you kind of, did we get away with hiding this kind of information, or did they not see it? And therefore they, Dave is just so great in the way that he says, look, we're not going to lead with the ugliness of this deal, but we're going to make sure they understand that it's there before they make an offer, so that there's not going to be any retrades. I have Dave and I own a commercial property, and yesterday a real estate guy calls me up and he says, hey, I understand that you guys own this piece of property. We'd like to buy it. And we want to know whether we can make an offer on it and whether you would entertain the offer. And I said, look, if it's not my wife and kids, it's for sale. And so he said, that's great. We really appreciate it. We'll get back with you with an offer. I said, wait. I said, what you need to know is on the the northeast side of that piece of property, there used to be a gas tank right next to the next door property, and it leaked over onto our property, and you're going to need about $100,000 of remediation costs. So factor that in. So I immediately told him that, because I know that before that thing is going to be sold, they're going to find that out. So they might as well know up front and factor that into the cost of the property. You see what I'm saying? And it's the same way. And when you're selling a business, you don't want to hide the fact that, that there's some hair on the deal, in some way. You want to make sure that before people make an offer, that they factor those things in, so that when the due diligence comes in and they get all the answers, they already know that exists, and they're not going to retrade on the price.
And that conversation is different from what we were talking about earlier, and wearing information that'll get somebody wearing an orange suit.
Right.
Those things are not things that are going to impact the future of the business, right?
That's
They're not
correct.
going to come back down the road.
Yep.
Awesome. Well, that's about all the time we have for today. Grant, anything that you'd like to add before we wrap up?
Yeah, I would tell you that, it never hurts to know what your company is worth. And so asking that question is a great question to ask. But I would say what's more important is asking yourself, what do I need to walk away with? In other words, forget price. After taxes, after debt is paid off, after fees and legal fees and all that kind of thing, what do I need to walk away with? And let us determine what the price needs to be in order for you to achieve that, because it involves structure and all kinds of tax planning. Because ultimately, if we think we can accomplish the price that is needed to get you what you want, net, then you might have a transaction on your hands.
That's awesome. Yeah, and I would just add to that, it's hard to set that goal of what you want to walk away with if you don't even know where you're at, right? So we can help with that conversation as well. And like you've said on previous podcasts, ultimately we want to get paid when the deal closes, but we're not looking to make money on people up till then. So come sit down with us. There's always a seat at the table, and we're happy to help you figure out where you are and start moving toward where you want to go. Right. Awesome. Well, hey, Grant, thanks for joining me today. And that's all the time we got.
Let's go.
And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.